It wasn't a missile test. It wasn't a military drill. But China just triggered the most dangerous ripple in global markets this year with a calculator. In just 4 days, Beijing offloaded $212 billion, 0 cents worth of U.S.-linked assets, sending shockwaves through bond markets, equity indices, and global investor confidence. No warning, no press conference, just a cold, calculated dump. Wall Street analysts are scrambling, central banks are watching, and nations tied to dollar liquidity are bracing for impact. This wasn't a panic move. It was a message, precise, silent, and undeniable. Because when the world's second-largest economy moves this kind of capital at that kind of speed, the question isn't whether there's a crisis coming. It's whether it already started. The timeline was short. Between Monday morning and Thursday night, Chinese financial institutions and sovereign accounts began systematically offloading U.S. Treasury bonds, corporate debt, and select equity holdings, totaling over $212 billion, 0 cents, in liquidations. At first, it looked like a portfolio adjustment, but by the end of day 4, it became clear this was a strategic dump, not a market correction. The People's Bank of China hasn't issued a statement, but global trading desks noticed the pattern. The sell orders were large, timed across global trading windows, and carefully designed to avoid detection until the volume became too large to ignore. By Thursday, 10-year Treasury yields spiked 47 basis points. The S&P 500 dipped nearly 4%, and the U.S. dollar index wobbled under unexpected sell pressure. And the U.S. dollar index dipped once under unexpected sell pressure. Beijing didn't need missiles or speeches to shake the system. It used liquidity as a weapon. According to Bloomberg Intelligence, this is the largest concentrated capital exit from U.S. markets by a single sovereign in under a week ever recorded. And it comes at a moment when America is facing rising debt ceilings, global distrust, and fragile investor sentiment. So the question is no longer if this was intentional. The question is, what comes next? According to leaked trading floor data and confirmed Bloomberg terminal logs, China's liquidation wave focused on 3 key segments: U.S. Treasuries, tech-heavy equities, and investment-grade corporate bonds. The heaviest blow came from the Treasury's desk. Over $108 billion, 0 cents, in government debt was dumped in less than 96 hours. That alone was enough to push yields to their highest point since 2022, sending alarm bells through the bond market. The second wave came from asset managers affiliated with China's sovereign wealth fund. Major holdings in companies like Apple, Microsoft, and Tesla were reduced or closed entirely, totaling another $70, 0 cents plus billion, in outflows. Though not confirmed officially, analysts at J.P. Morgan suspect this was done through European clearing firms to mask origin and timing. Finally, over $30 billion, 0 cents, in U.S. corporate bonds, mainly banking and energy, were offloaded at a discount, pressuring credit spreads and sending the Dow's financial sector into a tailspin. But the real shock wasn't just the numbers. It was the surgical precision. No market panic, no leaks, no disorganized selling. This was a coordinated, state-level financial maneuver, one that sent a clear signal. China doesn't need to declare economic war. It just needs to stop buying. The global markets didn't just flinch, they stumbled. Within hours of China's $212 billion 0 cents dump rippling through U.S. financial channels, reactions exploded across continents. Update from the U.S. Federal Reserve. In New York, bond traders were blindsided. The 10-year Treasury yield surged, triggering margin calls and forced liquidations in funds exposed to fixed-income portfolios. Equity markets followed. The S&P 500 dropped 4% in a single week, its sharpest decline since the 2023 banking scare. Tech stocks, once seen as untouchable, took direct hits as Chinese sell orders drained liquidity from megacap tickers. In Europe, capital flight intensified. German and French bond markets saw sharp inflows as investors sought safety outside U.S. exposure. Meanwhile, London-based hedge funds with U.S. dollar-denominated strategies began unwinding positions, fearing this was only the first wave. In Asia, central banks in Japan, South Korea, and India held emergency meetings. Currency markets became volatile as regional economies feared a domino effect. If China can abandon dollar assets this swiftly, others might follow. Even crypto markets reacted. Bitcoin spiked 9% in 48 hours, driven not by hype, but by institutional hedging. This wasn't a normal market correction. It was a warning shot. And the world heard it. Loud, clear, and deeply unsettling. At first glance, China's $212 billion 0-cents dump may look like retaliation or panic. But this was neither. It was a strategic recalibration aimed at weakening the very financial levers Washington has used for decades to project global influence. China has watched closely as the U.S. weaponized the dollar, imposing sanctions, freezing assets, and using its financial infrastructure as a tool of political pressure. In response, Beijing has been quietly constructing escape routes, digital yuan networks, bilateral currency swaps, and non-dollar trade agreements. This latest move? It's a message. We can unplug from your system whenever we want. By offloading U.S. treasuries and dollar assets, China isn't just reducing exposure, it's testing market reaction. How far can it push without triggering systemic failure? How fragile is American liquidity when the largest foreign holder of its debt starts exiting? At the same time, the move helps Beijing internally. With the yuan under pressure and capital controls tightening, liquidating U.S. assets gives China room to stabilize its own economy, without needing Washington's cooperation. This isn't a reaction, it's rehearsal, for a world where China no longer plays by dollar rules and the United States no longer controls the scoreboard. China may have pulled the trigger, but the tremor is spreading. Other nations, especially those already uneasy about U.S. financial dominance, are watching, and some are moving. Russia, long excluded from Western systems, doubled down on yuan-based settlements, confirming it has shifted over 90% of bilateral trade with China away from the dollar. Iran and Pakistan accelerated talks with Beijing to denominate key oil and energy contracts in yuan or dirhams. Brazil, a BRICS partner, initiated preliminary discussions to rebalance part of its sovereign reserves toward non-dollar assets following China's move. Meanwhile, Saudi Arabia, once the pillar of the petrodollar system, has reportedly begun rerouting a fraction of its oil exports to Asia through yuan-based clearing platforms. It's not abandonment, it's diversification, a signal that the U.S. dollar is no longer the only game in town. Even traditionally dollar-loyal partners like Turkey and Malaysia have increased usage of China's cross-border interbank payment system, CIPS, for regional trade. These aren't isolated events, they're signals. The financial world isn't ditching the dollar in protest, it's preparing for life beyond it. And China's $212 billion 0-cents dump may have been the catalyst that turned quiet hedging into open alignment. For decades, the United States held a silent advantage, the world's reserve currency. It gave Washington leverage without confrontation, power without permission. But now, with China's $212 billion 0 cents exit shaking confidence, that control is being tested like never before. So, can the U.S. regain command of the system it built? The Federal Reserve still controls interest rates. The Treasury still influences global liquidity, and SWIFT still routes the majority of global transactions. But these tools are losing influence. Not because they're broken, but because the world is building alternatives. Washington's traditional response, more sanctions, dollar pressure, and diplomatic warnings, won't work in a landscape where entire economies are hedging against the U.S. financial model. Even allies are starting to diversify, not out of defiance, but out of necessity. To restore control, the U.S. may need to rethink its strategy entirely. That means rebuilding trust, reinforcing partnerships, and possibly even decentralizing elements of its own financial architecture, before China's rails become the default. Because control isn't just about dominance, it's about relevance. And if the U.S. can't reestablish itself as a stable, collaborative force in global finance, then it may find itself sidelined in the very system it once ruled. This isn't just a sell-off. It's a signal, a $212 billion zero-cents message from Beijing that the age of passive cooperation is over and a new financial battlefield is forming beneath the surface. For decades, the dollar wasn't just a currency. It was compliance. It was control. But now, China is showing the world that liquidity can be weaponized without a single sanction, and global markets can be shaken without firing a shot. What happens next is bigger than 1 week of bond sales. If more nations follow this path, if even a fraction of global reserves begin shifting away from U.S. assets, the very foundation of American economic power could begin to crack. And here's the question the West now faces. What happens when the next global financial crisis hits and the world doesn't turn to Washington for rescue, but to Beijing? What happens when China isn't just dumping dollars, but issuing the next bailout? Because if this was a test, the message is clear. China doesn't need to announce its rise. It just needs to move money, and the world will feel it.